we are going to transition over to Queen's Court. And for those of you guys that are watching this for the first time, Queen's Court is an area of Tuesday's halftime report where I come in and I'll ask a question to these wonderful coaches and just pick their brain as to what I'm thinking in my own portfolio, what emails we get from students or questions we get from students here. And obviously, being that we're obviously Team Tackle, we've got tech coming in tomorrow with Microsoft and all the other ones. We've talked about Microsoft here and how to manage covered calls for the better, probably like all year long when it comes to Microsoft, is just managing those covered calls. And I love when we have these little mini coaching sessions where we get to talk, just trade management. So I'm bringing Microsoft back to the table because it does have earnings tomorrow. I have it covered right now on a 290 strike price.
How long have you been an investor in Microsoft?
Don't ask.
It's I want to say 5 years.
Quite a bit.
Maybe more.
I don't know. It's been there.
It was early on when I met you, so it'd be like
it wasn't my first one because I was very heavy on Netflix and Amazon, but I started to love on Microsoft and added it to my portfolio because I don't always want to have crazy in my portfolio. I also want to have nice and steady.
Yeah, well, that by the way, that happened after you did the so nice and steady, right?
Exactly. Then Microsoft decides to get crazy on me this year. So it's been a lot of managing covered calls here with Microsoft, and it's not going to be anything different with earnings coming out tomorrow. How would one approach Microsoft?
Are you covered currently?
I'm covered currently.
Okay.
Here's my dilemma. I've got 71% of premium collected on the 290.
Okay.
24 days out.
You've already collected 70?
I've already collected
Matt
70.
and I are going to have the same answer.
We're going to have the same answer.
Why are you covered into earnings, capping your upside when you've collected most of the premium?
No, that's the question. Let the question happen.
Yeah, that is a question most people will peg when they're sitting at something, whether it's Microsoft or not, right? I know what the answer is for myself.
Yeah.
But I'm pretending that we've got brand new students watching.
Yeah, Emily's cutthroat trader. She knows what she's doing.
And they're sitting on a covered call where they've got most of their premium collected. In this example here, I've got until 4 o'clock to obviously do what I need to do. But in this scenario here, you've got 71% of your cash flow collected, and you've got earnings being announced later on today after close. What should one do?
Well, on the call side, Chucky, I think that's obvious. First of all, on an earnings position, you never leave something just covered. Okay. You're capping your upside with unlimited downside. And that's an inverted reward to risk ratio, which is insanity. So you never carry covered through earnings. I remember way back in the day, like in 2013, it's like 2015, I did like a YouTube 20-minute video on covered calls, right? And at the end of it, I did a covered call example on a stock, and it was probably like FCX or something like that, because FCX, I've been doing covered calls on forever. But in terms of that, some guy, I don't know who it was, about 2 months later writes a message in the chat of that video and says, "Wait, but you didn't tell us about earnings." I'm like, yeah, because it was a 20-minute video on covered calls on YouTube, but that's not education. What are we talking about? Like, yes. And so for here, you never leave a stock purely covered going into earnings, because what happens when you do that, let's take Microsoft, for example, here. Let's go into the Analyze tab. Let's go into the risk profile. Let's just add 100 shares here, Em. Okay, just to make it easy. All right, when you go into earnings season or earnings and you just own stock, okay, you have what's called an open-ended risk graph. It's open-ended on the top side, which means if Microsoft gaps up, you make money. If Microsoft gaps down, you lose money, right? Very simple to understand, okay? Now, you can do that going into earnings. In fact, that's probably the number one thing most people do going into earnings, and I'm talking most investors, right? Is they just leave it open. You got to deal with earnings 4 times a year. 4 times a year. A good company like Microsoft, what do they typically do? Expectations are lowered going into earnings. They beat, boom, 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 right? It's a decision you have to make, but if you make the decision to leave it uncovered, that's fine. What you cannot do is come to the market, and you said you were 24 days out right now, 290.
Yep.
What you cannot do is come to the market at 290 and say, you know what, let me sell that 290 strike price. Okay, let me sell that 290 strike price, and then what happens to the risk graph? Well, if you sell the 290 strike price in the covered call, it's going to flatline the right-hand side of the risk graph, which means if Microsoft gaps to 310 tomorrow, you're capped at 290. Okay,
Yep.
you have capped your return here. That's what you're doing in a covered call. You're capping your return to bring in some cash flow to make sure you're monetizing the asset over time. Because when you think about trend analysis in the market, we always think the market's in some degree of trend, bullish or bearish, right? The vast majority of the time, the market's in some degree of sideways neutrality. It pops, sideways neutrality, good trend, pops, sideways neutrality. There's been times when Russell 2000 has literally lived in sideways neutrality for 2 consecutive years without a breakout. And so you don't want to just cap your upside potential. And so what you do, if you are going to have concern of the report and you are going to carry that covered going into it, what you need to do is you need to add that put option to offset the risk graph. And as you can see, what I just did is I added a put option to offset the call we've sold. And what that does is it caps the downside. And so as you can see, we're capped above 290, but we're also capped underneath 260, which means you've limited your loss. And so one thing you can do if you are going to cap the upside with the covered call going into earnings is to simply add the put option. Now, a lot of investors would prefer to not cap upside potential on a company like Microsoft that you have a long-term vision for. And so in that scenario, you simply remove the covered portion of that, which I think you should do, given the fact that you've already captured 70% of the premium. And so you've already captured 70% of the premium. You only have, you're basically, fighting for a nickel and a dime out there when that's uneven from a trade perspective. You are not ratioed against that call option, against that put option. So I would, if I were you, because you've already captured 70% of the value, I would uncover by buying back that call option, leaving it uncovered, which means the question you ultimately have on Microsoft tonight is not what we're talking about is the caller trade. It is not to caller because you're going to bring back that call option. And I know you were going to do that anyways, given the fact that you only have 30% of the value to capture. But I love this question so much because it allows us to go into, it allows me to put the educational hat on a little bit, right? Allows me to put that mentor hat on a little bit. And so if I were you, I'd be looking at the environment and say, okay, we've captured 70% on the covered call. It's a long-term investment for you. You love the stock. You don't want to mess with it getting taken away from you. The most likely response on Microsoft over the last 30 years is up on earnings, not down on earnings. And Microsoft isn't necessarily the company that will drive like a Google will or something along those lines. And so the question I have for you, young lady, is not whether to call her, but in this environment where the top end of the market is showing a little bit of increasing volatility, Microsoft has violated short-term support levels, and obviously earnings are the variable here. But the one thing I would think that you could do is marry the put option to the stock and do it more of a protective put option. So for example, you cannot carry a single covered call through earnings. You cannot do that. That is terrible, terrible mechanics. But you can just add a put option here if you're concerned, right? And so if you are concerned and you want to limit the downside for whatever reason, you can go to the market and you can buy a put option to cap that risk to the downside. And so what I would do here, Em, and I do think it's a difficult choice. I do. Microsoft's a great company, and it's been one of the leaders in the market. Like if this was XYZ commodity stock reporting tomorrow, like no, let's get the put, let's sell the call, let's collar the trade, let's eliminate the earnings risk, and that's what the collar does. It eliminates the earnings risk, right? Microsoft, I don't know. I don't have that philosophy that this is one of those companies that you just got to look out below for on earnings. When you look at the recent history on earnings in Microsoft, you got an earnings report here, an earnings report here, an earnings report here. You know, I'm not seeing a lot of just sell. Even on the gap downs, Microsoft recovered the price fairly quickly here. So I don't know. I think it's a difficult choice, quite frankly. I would probably add a cheap put option just to give myself a little bit of semblance of insurance, and that's more just to make myself feel good about the situation. But I want to carry. It's either collar, which means buy back your call option and reissue the call option, add a put option, do that collar, or simply buy back the call option, take your cash flow you received. I mean, you made 70% on the call option. And Emily, I know you've only been in it like 5-6 days. So, I mean, you're ching there. It's good. It's good. All right. I think I would take that cash flow and add some put options to eliminate some of the gap down risk.
Coach Mark, I know you said your answer would be the same to Coach Matt. So
yeah,
add to that.
You know, the one thing I always wrestle with is because I know you are married to Microsoft, right? You know
long term,
this and that, and so it's always hard for my rent-a-stock brain to like truly give the best advice to someone who doesn't have a rent-a-stock brain, right? You're married to this and all of that. So, but 100% agree with the whole. If you are an investor in this stock and hold it long term, you can't cap your upside, right? You can't cap your upside on earnings. And so the whole short-term protection thing makes sense if you're spooked, right? And I think that a lot of the only thing I'll add to that is, if I only had like 35% exposure to the market, right? And then I'm probably not as worried about protection. If I got 80-90% exposure to the market, well, I need to not, that calls for more protective type measures.
Gosh, right? You've made what, 400 on the bleed of that call option so far?
400? About 900 because I sold it when it was at the money, so it was running.
Oh, so you're so I was taking the 600. So, which means you're up about. Yeah, take some of that cash flow you made in the last week and add your insurance and make you feel. It makes you feel good about the environment. You were able to insure your asset with somebody else's money. You're basically doing a collar. You're just buying back the call option that you sold last week. You're using that cash flow to add some cheap hedge to it. Yeah.